We're joined by Michelle Girard, Chief U.S. Economist at NatWest Markets, and Jim O'Sullivan, Chief U.S. Macro Strategist at TD Securities. And this is a conversation that we've had. It's kind of the irony that we say it's a rush to safety in a market, a bond market that some people think is so overvalued globally that it's just hard to really call that are you safe when you buy a bond with some duration that basically has zero yield?
Well, I guess it's, you are at least still getting a positive yield.
Of your principal.
Well, you're getting the return of your principal, and versus, a great portion of debt overseas in particular, you're getting a positive yield.
So
and
it's relative.
It is all relative.
Is it a safe haven now? Yeah.
I mean, the perception is that inflation is not an issue. Obviously, recession risks have increased in the last month. I mean, that's what's driving markets right now. If we do get a recession, inflation's only going to go down. I mean, the Fed's going to go all the way to zero. And then some in terms of other actions. So I think people are just generally looking at in terms of risks, and I mean that's what's driven the market.
Yeah, I mean I believe the Fed's going back to the zero bound, and so in that sense, I think you've got people. Even though I think the Fed's been very clear, negative rates isn't on the table. I mean, this is the kind of thinking that people are starting to price in probability of.
Everyone says we've seen it in Europe and it didn't work, so let's not do it here. Well,
negative rates,
right?
Oh, yeah, I don't think this Fed will take rates negative.
I know, but
yes.
but it's not our choice. This is being given. This is being handed to us, and so the Fed is following where we're going anyway. That's I think. We try to blame Europe and say, what were you central bankers thinking? But they were responding to the economic conditions over there as well.
I mean, the funds rate is a choice. I mean, it's a question of what else they do.
But you can't leave it way too high than it's supposed to be, can you?
Well, I mean, we still have 100-plus basis points to go to zero. And,
good.
I mean, we think they do another 50, and then they stop. But that said, I mean, if necessary, they keep on going. They go back to the 0 to 25 range. And then they come back to QE and various other alternatives. But they don't have to go below zero on the funds rate. And certainly the signal from Fed officials generally has been that they don't think it's a good idea in the U.S.
What about the balance sheet? Where does that fit in? Because on all the past crises that we've had about 500, 600 basis points, 5 or 6% to play around with. Obviously, we don't have that. So where does the balance sheet come in, and how has that changed the dynamics, and can that avoid? I know that you had said that you don't think we're going to negative rates, but how does the balance sheet take effect?
That would be part of the game plan. I think the presumption is they use conventional short-term rates first, so there's 100 basis points left there. They run out of that, then they come back to QE. Right. I mean, I think that's the sequence. And then there's talking about other yield curve control measures, starting to kind of cap interest rates out the short end of the yield curve to reinforce forward guidance. And then there's various targeted measures they could use if you've got stresses in the financial system, which, as Joe talked about earlier, there's no significant sign of that at this point.
I think they may use the balance sheet even sooner, or in some ways, for example, stop the runoff in MBS. I think you might see the Fed start even before we get to zero. I think the other thing that will be interesting is will they ultimately need to take completely different measures to address whatever hits the economy? You think about the financial crisis and some of the TALF and some of the programs that they saw that were necessary. If this turns into an event, for example, that starts to limit credit to small and medium-sized companies, which I think are probably the most vulnerable, to the outlook that we're expecting, do you have a situation where the Fed starts to get creative in terms of how it provides liquidity and it starts to expand its balance sheet in other ways that we hadn't even seen during the financial crisis?